everyone. Can you hear me?
Hello. Hello.
Hi. Okay, I'll try to turn my camera on so that you see me.
Bonjour.
Hello, hi everyone. كيفكم?
هاي تمام.
Hi.
Hi.
Thanks
Hello,
for
everyone. Thank you.
Hi, Joanna.
Hi.
Listen, guys, if you're not using the microphone, just please try to mute it so we don't hear the noises next to you, please.
Okay, guys. Thanks everyone for joining. Well, this session, as you probably know, should have been a live session, but due to exceptional times the exceptional times we're going through, we had to have it online. So thanks again for joining. This is one out of two sessions. We decided to actually split the finance session into basically because generally the feedback on finance sessions is that they're a bit heavy. So in order for the material to be a bit lighter on you and also to have time, you know, for questions and for any kind of intervention. So I know most of you are in the INJAZ program and you're in the process of setting up your own startup. So just for me to have an idea about like who has previous knowledge about finance, if can you just write me in the chat if someone has a financial background, or if someone has a financial background, just write yes, please. Okay, Farah said yes. Okay, not really. Okay, no problem. So this is going to be like more like an introductory session where I'll talk mainly about accounting, you know, accounting fundamentals for you to eventually, the objective of this is after the second session, which will take place on Monday, so that you're able, guys, to understand the basics of a financial model, for you to be able to build a simple financial model, you know, that reflects the story of your startup. And because I mean, at some point you will have to present your startup to maybe investors or you know, board members or any person who's interested more in your startup, and having like a basic knowledge of the numbers is very important. I will try to not to go in depth, because I want you to have a general idea, and you're not supposed to become experts in anything, but just to understand the principles behind what you're going to be doing, you know, in your financials. If you have a question, so the session is supposed to last till 4:30. I'll try to go fast as possible while not distracting you, so that you're able to follow. If you'd like to interrupt me, please write me on the chat or raise your hand. There's supposedly a way for you to raise your hand here on the Zoom thing. Okay, so what we're gonna talk, okay, let me share my screen. Okay, you probably see my screen, right?
Yes.
Okay, perfect.
Yes.
Okay, great. So I'm gonna start by talking about revenue models, because I realized it's important. It's not directly a finance concept, but I want you to understand, each and every one of you, I want you to understand why it's important before you start thinking about your financials. So, I think for today, I'll cover the two revenue models and the main types of revenue models, the cost structure, and maybe one financial statement, which is the income statement. Okay, and then for next time, we will have the two other financial statements and the basics of building the financial model along pricing. Okay, so does anyone have an idea what is a revenue model? If I tell you what's the revenue model of your startup, does anyone have an idea? If someone wants to answer, just unmute yourselves.
By revenue model, you mean how you make an income out of whatever business you're launching. هذا in simple terms عم نحكي.
Exactly. So this is the answer. Sorry, what's your name?
Rafi.
Okay, Rafi. Yes, exactly. This is it. So a revenue model is basically how a startup makes money and how it generates money from the sales of its products and services. So the main thing, I mean, I'm sure all of you know that when you started working on your startup, we emphasized a lot, the problem, and like find the problem and then build a solution. But once you've done that, you've identified a real pain point, a real problem, a real challenge, and then you were able to build a solution. Then comes the question, how am I going to sell this solution? Okay, and what am I going to sell? Am I selling a product? Am I selling a service? Am I selling a subscription? Am I selling, say, you pay monthly and then you have access to a number of services. Sometimes in apps you find like a number of features for free, and then if you want additional stuff, you will have to pay for them, and this is called a freemium model. Okay, so this is basically the question of a revenue model that's important to tackle no matter what your startup does, whether it's a social enterprise or not, it doesn't matter. It's a question that applies across the board. You have to once you have identified the problem and the solution, you have to think of the ways in which you can make money and how you're going to sell what you're going to sell. Okay. So in simple terms, so generally a startup is offering customers a solution, a product or a service, and in exchange, the customer is paying a revenue, okay? And like this kind of representation, this is basically a very simple or a simplified representation of what a revenue model is, okay? This is basically a sentence that summarizes why a revenue model is important, because generating revenue will help the long-term viability of your business. Understanding where it fits in at the start of your business is vitally important. So you need to understand basically the revenue generation process of your business. I'm going to give you an example before we go into these examples actually. So for example, you're all familiar with the Nespresso brand, right?
My favorite brand.
Okay, great. So this kind of business model where you go and buy a relatively affordable coffee machine and bring it home, and then you get kind of hooked to buying the capsules, right? So this is called basically a razor and blade kind of model, where you buy one thing and then you're obliged by the nature of the product to buy like the stuff that needs to make this thing work. Okay, this is, for example, this is like had Nespresso been selling just the machine, just the machine, and then you'd be maybe buying your own coffee separately, like the whole model wouldn't work. The only reason why they're working and they're making so much money now is because every person who has a machine has kind of almost a subscription to the brand, because they go and buy their capsules on a regular basis. Okay, so here on the slide, you see a few other examples of, I just want to give you an idea of other business models. So does anyone want to tell me, for example, you can choose one of these and tell me how do you think these businesses, or like the business you chose, makes money?
Well, Netflix works by subscription.
Yes.
So, yeah, so he need $10, I think. So
yeah,
you get عندك premium if you wanna get more users, more people to use the channel. So it's only more than one person. Uber is حسب الرide يعني, so anybody can become a driver.
Yeah.
And تدفع on every ride دغري on the spot. Facebook by ads, LinkedIn, and the other ones I'm not sure actually.
Exactly. So the Uber model is has become really like basically a standard, and other like businesses are now using the word Uberized, and they're saying that they're Uberizing their model when they create a platform basically, and they bring demand and supply on it. Okay, and this is made possible because of the what we call the sharing economy, the whole so the sharing economy that we're living in, and Uber in particular, and and all the models that resemble the Uber model are actually what we call transaction enablers as a business, as a revenue model. By the way, many times you will hear people using the term business model interchangeably with revenue model. It's almost the same thing. It's actually telling you how the startup is making money. And when we say transaction enabler, think of Uber, think of Airbnb, think of any platform where you go as a demand or supply entity or individual, and where once you make a transaction through that platform, they take a cut out of it. So they're enabling the transaction, and the revenue model is basically a cut out of this. Okay. For the others, you know that Facebook makes most of its revenue through ads. Recently, like they have diversified and they have added other revenue models, but the main, other revenue streams. So this is a small nuance I'd like to make here. So the revenue model usually is how a startup makes money. And if in case a startup has several ways of making money, each source of income would be called a revenue stream. So if, for example, going back to the Nespresso example, they're selling machines, like, you know, the coffee machine. The coffee machine sales is a revenue stream on its own. And the sales of capsules is another revenue stream. Okay, so many successful businesses end up at some point diversifying what we call their revenue streams in a way for them to have income from several sources. Okay, that's why you hear of let's say they set up something. Think of, I don't know, an irrigation system. We have a startup at Agritech. I mean, currently at Berytech, our program that's funded by the Dutch Embassy, so co-funded by the Dutch Embassy. So basically, one of the startups is thinking of a revenue model where they charge. They're selling basically an irrigation system, and they're thinking of charging for the setup of this system at the customer on one side, and then they would also charge the customer a subscription fee through an app, so that the system keeps working and keeps being able to be remotely managed. So this is a simple example where you can think of two revenue streams within the same startup. A lot of startups, a lot of companies have, for example, their main line of business, and they also at some point are able to, for example, diversify into ads, or like having, you know, banners or ads on their website. This is another revenue stream. So this is just to tell you about the concept of a revenue stream and how it differs, or how it fits into the big umbrella, which is the revenue model. So a startup has its own revenue model, and many times, or oftentimes, we find startups having several revenue streams. Okay, so for the other examples we have on the slide, for example, LinkedIn, it has like subscription plans as well. LinkedIn is basically what we call a freemium. It has a freemium revenue model. Why? Because it's free for everybody. If you want to sign up on it, you can sign up, and you're not supposed to pay anything to have a profile. But then at some point, if you'd like to benefit from all the features of you know, job searching and analytics, and basically where you fit within the pool of applicants, and like, you know, having the engine suggest jobs and stuff. So this is when you'd need to subscribe, and then they have different subscription plans that we're going to. Sorry, can I just ask you guys, whoever is not talking and forgot his mic on unmute, to mute it? Okay, thanks. So this is just okay. I'd like just here to highlight a key difference between the concept of a revenue stream and the price. Does anyone want to try to tell me what's the difference between the two?
The price is technically قدام بتسعري القطعة. Revenue stream is the way that you're getting paid. So let's say مثلا you're getting paid via online, or if you have your items at a shop, so you have two revenue streams ساعتها هون.
Yes.
هذيك ما خصها، هذيك هي سعر القطعة. Just individual.
Yeah, exactly, correct. So the issue is that the revenue stream has more to do with the strategy you have to generate cash, or the way you're going to generate cash, whether you're going to sell, as you were just saying, whether you're going to sell a product, you're going to sell a service, you're selling a subscription, you're selling a service, you have an e-commerce platform where you put your products on it. The pricing is more tactical. It has to do with how much am I going to charge. And usually what happens, like the order of things should be, you have to decide on your revenue model, your revenue stream, be it one or many. And then once you decide on the strategy, so for example, I'm going to sell this product, or I'm going to sell a subscription to this platform, or I'm going to sell this service, then would come the tactical exercise of pricing. Today, we're not going to discuss pricing. I leave this for the session on Monday, but I wanted to make the distinction now for you to keep it in mind. Okay, so regardless of how good your product, service, or app is, it's only useful when you can get it into the hands of your target customers, okay? So it's important to think of target customers first, and of their habits, and of why they would buy according to one revenue stream or and not the other, okay? But you've got a first offering. It should be easy, but the answer is no. Why? Because so the starting point is right target customers, and then you have to devise the right offering, be it a product or a service, and then you think you're done. But the answer is no, you're not done, because you have to think of how you're going to propel this product into the market. And this is where the exercise of thinking of the right revenue model comes in. Okay, and this is very important, because the same product or service can be perceived by the customer as expensive or cheap or affordable or even interesting, depending on the way you would price it. Okay, so think of let's say think of a monthly subscription that you can cancel anytime, versus say this same subscription had it been yearly. Okay, I think most of us have been in a situation where, because of the fact it's a monthly subscription that we can cancel, we're more inclined to go for it. So yes, please.
Is a question about this specific point. When you say you have to, the revenue model has to make a whole difference for customers to keep coming back.
Yes.
Are we talking also about upselling here?
Upselling would, yes, akid. Upselling is is a related concept, but it's not directly what I'm saying. What I'm directly saying is that the customer, once he wants to decide whether he's going to purchase your product or service, there is basically there are two things he's evaluating. He's evaluating the product and the solution itself, and then evaluating what you're asking him to pay for it. And what you're asking him to pay for it falls under the revenue model. So that's why it's important to think of the revenue model in terms of what we call the perceived value from the customer's perspective. So what's important is that the value the customer perceives is higher than the price you're actually charging. Because once this is clear in the mind of the customer, once the customer is almost convinced that the value they're getting is higher than the price you're charging, buying is almost guaranteed.
Okay.
Sorry,
Okay.
can I add something?
Yes, sure.
Okay, so here in this case, what you are speaking, if we talk about upselling, sometimes it will hit what you are speaking about. Sometimes when we try to push upselling so much, we will
Yes.
get the products. Let's say I have 2,000 to buy a piece of cake. So if I tell you, please take one coffee with it, it will be 7,000. I will not buy
Yes.
it, or I'll buy it one time and I will not get back. So we have to be here careful, because sometimes upselling can ruin what we are to do.
Yes, exactly, and that's why it's important to when you're selling something. It's important from a founder's perspective to understand how much you're asking your customer to pay in total. Like in the example you just gave, maybe the budget of the customer is not more, for example, than 5,000. So being able to upsell would work up to 5,000, but then beyond 5,000, it would just defy the purpose, and they wouldn't buy more. So that's why when I say, if you look at the first sentence, so looking it's only when you can get it into the hands of your target customers, you have to think of the need of the customer, sure, but you also have to think of basically their purchasing power and the whole persona and how much they're ready to pay for something. Okay.
Okay. Thank you.
Okay, you're welcome. This is a quick exercise I invite you to do all later on. So in case it's not yet clear for you, you need to visualize or think of your target customer as a persona. Who's that target customer? Who am I selling? And for those who, I think you're all familiar with the term, but for those who are not familiar with the term, a target customer or your customer persona is the primary customer. So the ideal customer for whom you'd be selling what you're selling. Okay, if you were to visualize or to describe this customer, who would it be? Would it be I'm just giving random examples. Would it be in agriculture? Would it be a farmer? Would it be a businessman? Would it be a mom? Would it be a teenager? Would it be? It all boils down to the initial problem you have identified. But it's very important to put on paper or to clearly have identified the target customer, and then think of what you are offering them in terms of product or service, or am I giving them, for example, access to a platform? Am I giving them a service for which they would pay? Am I giving them a product directly? Am I giving them the possibility of connecting with an expert? Nowadays, like with this whole crisis, you see everybody going online, so like all kinds of experts are online now, and then you can connect with them, from doctors to doctors, healthcare professionals, lawyers, everybody's online now. So just like it's important, after having identified your target customer, to identify what you are offering them, and then think of the revenue model you want to implement, basically to bridge the target customer with the offering. Okay, so this target customer, I'm offering them this, and I'll make them pay that for this. Once this is clear for you, obviously you'll have to validate this with a number of customers. You need to pilot the model, but this is the start for you to, these things have to be clear for you. And once they're clear, you can actually either validate them or disprove them in reality, and then adjust or pivot accordingly. So this is the model.
Question? Just one
sure.
question.
Sure.
When you have multiple client personas,
yes.
So each one may, but it has to be tailored to each and every single one of them according to the client persona, the revenue model.
Okay, so we always have this question, we always get this question, and the answer is the following. In case we're talking of one service offering, there is always one primary persona. Okay, so it's natural to have several personas, but think of the main one. This is like in case there is one offering, but in case you have several offerings and then every offering has its own persona, yes, it makes sense.
Okay.
Okay, so and then you would be targeting every persona separately based on the offering. So let's say I don't know, let's say you're a beer company, and then you have, you know, the normal beer, and then you have the non-alcoholic beer. Maybe you'd be targeting, you know, I don't know, like pregnant women or like a different segment. It depends, you know. But if the point is, if the service offering is different, it makes perfect sense to target different personas. And this has to be done also like from a branding perspective, from a communication perspective. But if you're just starting, it's always recommended to focus on one persona and then to nail it with that persona before actually moving to another persona and another service offering. Because oftentimes when you're starting, people don't know you. So before you're able to have like a wide service offering, you have to start with one thing and kind of make sure that you have an audience and that people are there hearing you before you move to something else. Because what typically happens is that once you build an audience with the first product, you know, and the first target persona, then this target persona itself would maybe, you know, listen to you, and there is kind of a virality effect or a networking effect, other people. So the idea is that you'd have built yourself basically, you know, what we call brand equity, or a certain you know, image or a reputation or something. So it's always recommended to start with one persona. But then eventually, of course, if you have, you know, as I said, a service offering that, you know, a wide service offering, it makes sense to unroll it, but do it gradually. The point is not to do it at once at the very beginning, not to confuse people.
Yeah, exactly. Because I know, because that's the whole point. You know, trying to do everything at once, it's getting me too confusing, بصراحة, especially at an early stage.
لا, don't عن جد. I mean, I strongly recommend you focus on one thing first for you, from a, you know, resources perspective and focus perspective, and then it will give you enough time to you know, to spot basically inefficiencies and mistakes and correct them. And then once you want to redo the exercise with another thing, you'd have derived a few learnings, and it would be easier. And in the mind of customers, most importantly, you would have basically built some brand equity instead of just like, you know, having them get lost with a wide service offering and them not being able to label what you're offering.
All right, gotcha.
Okay.
Thank you.
You're welcome. So, okay, so back to this example of LinkedIn, I'll just go through it super fast. So I told you they have several plans. So their model is freemium, so it's free for everybody. But if you want additional features, even here you have several options. If you're basically looking for a job, you have the first plan. Then if you're a business, no, actually the first two are for professionals, but the second one gives more access and insights. But then if you're a company and you're in the sales function and you're looking for leads, you have the third option. And then if you're a recruiter and you're actually using LinkedIn to look for potential candidates, then you have a plan for this. So what they were able to do, they were able, as you can see on this slide, they were able to segment their customers by profile and by persona, basically. And the persona is driven by the needs. So every segment has, or every persona has their own needs, and they accordingly developed a service offering and a pricing as you see, the pricing is different, that fits, the service offering, and that can be afforded by the persona. So for example, someone who's looking for a job can afford $29.99 per month, but versus a recruiter who's typically a company, and where the $119.95 per month makes sense. Okay, so this would come later on, but just to give you an idea. This is another example. I'll not spend a lot of time on it because we're already half an hour through the training. Okay, cool. So I'll send you this presentation, so you'll have access to all the revenue models. We have 16 revenue models here, but I'm not going to present all of them now. I'm just going to present a few that are basically recurrent and that we see a lot nowadays. If someone has a revenue model that I didn't mention, that I will not mention in the coming 5 minutes, please interrupt me and just ask me about it. Okay, so like the most rudimentary revenue model is the production model. So when you produce something and you basically price it at a price that is higher than the cost, and you sell it. So this is how you generate revenue. This is the production model, very straightforward. Another like straightforward model has to do with renting. Like think of the whole rent-a-car business, or like everything that looks like it. Basically, you get assets, okay, and then you rent these things, and this is how you generate revenue. And yeah, excuse me, can you please mute the microphone? Okay, thanks. I was telling you about the rental model. So in some cases, you can see companies actually, implementing both the production and the rental model together. We have an example of one of these at Berytech. It was like last year. It was a company that produces machines to sort apples or fruits in general. And their initial model, it consisted in selling the machine to municipalities and to, let's say, governmental entities. But then they realized that these, institutions, entities didn't have the budget, didn't have the means to pay for this. So they came up with another revenue model without removing the first one, if somebody wanted to, purchase the machine, which was the rental model. Okay, the advertising model is also straightforward. It's when, for example, say for example, you are a platform and you have space on your website, and you get, companies or other startups to advertise what they do, their services on your website. This is an ad model, and it also applies in the non-online world. So in the offline world, think of ads in a magazine or billboards or anything. But as a company, it's typically nowadays, when they say it's an ad model, it's usually an online platform or an app where other companies can come and buy space and pay for this space, and this is the ad space that the startup would be selling and making revenue of. Okay, the commission model, the most straightforward example would be the whole real estate market, where, for example, if you are a broker and you're able to put in touch, a landlord and a buyer for an apartment, you get a commission on the sale. So this is a high level, as an agent or as a broker. This is the commission model. So the e-commerce model, maybe I'll go through everything. No, not through everything, but these are important. The e-commerce model is basically, it's a straightforward model where you have a platform online and where you put your products and services and you sell them through that platform. So it's sales. Sorry, someone has a question. What if I'm selling an activity has the same concept of the first model? Okay, can you please, Mona, can you please just unmute your microphone and ask me the question because I'm not sure I got it.
هاي
هاي.
سوري كتبت غلط.
مش مشكل.
قصدي إن إذا أنا I'm selling an activity يعني إذا مقدم لهم activity
Yes.
بتاخد نفس الموديل تبع أول واحد تبع البرودكشن يعني is it the same؟
لا
لأنه
it's not the
هنيك
same.
حيضل البرودكت عندهم.
إيه مظبوط. لا أنت when you're selling an
بس
activity.
هون I'm given an activity يعني.
Yes, yes. In this case, it's more what we see on this slide, which is fee for services. So you're offering a service and they're paying for it.
هلا وصلنا أنا سألت السؤال قبل. My bad.
ولو what kind of activity you're selling?
بركي sports activity.
Like classes, you mean?
فينا نقول like a journey مثلا it's a street ball نقول.
Okay, so they pay for the service. هلا they pay for the service and then you will have to decide whether you sell the service every time or you sell a package or you sell a subscription. Okay.
Thank you.
You're welcome. Okay, so fee for services, this is an example of fee for services. Another example would be when you're selling, say, I don't know, training services or coaching services or any kind of, you know, consulting services, legal services, everything that where, you know, there is a professional and where they get a service fee. This is a fee for services kind of revenue model. Okay. The licensing model is less frequent. We see it much less, but I'll just say a couple of words about it. It's basically when a company, you know, has a certain innovation in terms of process or product, or usually it's in the pharma industry when they come up with a medication, they have kind of the license, which means that for somebody else to go and do the same activity or manufacture the same product, okay, this other company has to pay, so they buy the license and they pay the initial company what we call royalties. So it's a model that's very close to the franchise model, which is basically built on the same premise, according to which if, for example, McDonald's, before it came to Lebanon, so once someone in Lebanon decided to get the McDonald's brand to Lebanon, they had to pay royalty. So they got the brand. Obviously, there is a whole procedure and they have to implement the whole thing according to certain standards. And there is a manual and like the standards are very strict. That's why you get the same experience in all restaurants around the world. But the thing is, in terms of revenue, the mother company or like the initial company gets royalty fees. What does royalty fees mean? It means that it's usually a percentage of the sales that the other company makes. So say I am McDonald's Lebanon, I have to pay 5 to 10% of my sales to the headquarters or to the mother company because they gave me, you know, their name and their, you know, recipes and their their processes. So this is a revenue model, but it's not very, to tell you the truth, we don't see it a lot among startups. Okay. The markup model is the traditional model, according to which, say you buy something from a distributor, or and then you put a small markup on it, say 10-20%, and you sell it. Okay, it's very traditional. Think of FMCGs, think of retail. This is basically the model in general. Okay. Just move to the next slide. I'll not mention anything about the model. Data sales model is when you know, nowadays data has become so precious. So when a company is able to sell data that relates to, for example, you know, the demographics or the profile of its customers, or you know, their buying habits or their behavior, or all this has become you know, so valuable nowadays. So they sell the data, and you know, in exchange they get paid for it. The model in the lower quadrant on the left, the transaction enabler model, is the whole model I was just talking about a few minutes ago. Think of Uber, think of Airbnb, think of all these platforms where you get, for example, freelancer, where you know, people looking for other people to do some work for them. So both parties get on the website, and then they get connected, and then like the website takes a percentage of whatever will be paid from, you know, the customer to the consultant, say. So it's it has become very popular nowadays, because mainly because of you know, the surge of the digital activity around the world, and how people are doing everything online, and how like people have basically moved online even more so nowadays. Okay, the marketplace model, some people confuse it with the transaction enabler. The main difference between the two is that the marketplace is just a marketplace. So think of OLX, for example, where you have the buyers and you have the vendors, and once they connect, the sale is made, and OLX does not take any cut on the sale. Okay, versus the other example I gave in the transaction enabler. So think of Uber, think of Airbnb. Every time you kind of buy something on these platforms, the company, be it Uber, be it Airbnb, or any other, takes a percentage. So this is its whole revenue model. Okay. Now for transaction enabler revenue model, volume is key, because typically they're taking a cut, and for the company to become profitable, there has to be enough volume, you know, for revenues to cover the costs. Okay, we've talked about the freemium model. The freemium model applies in different circumstances. It can apply in apps. It can apply in games where you can play up to a certain level, and then they ask you to buy something for you to be able to continue playing. The LinkedIn model, so so the LinkedIn model is typically an example of both a free and subscription model, because you have it for free if you want, and then if you pay a premium you get other things, but then you have to pay monthly, so it's a subscription model as well. Okay, so the subscription model is clear to you, I guess. Think of Netflix, think of LinkedIn, think of a lot of platforms nowadays where you can subscribe and pay a monthly or a yearly fee. Even there are a lot of apps where you pay something yearly and it gets renewed. So this is a subscription model. And last but not least, there is nowadays the affiliate model. Basically, I don't know if you're familiar with it, but usually it's very popular on you know, on YouTube, where, for example, you have someone presenting something, and like not only on YouTube, like with influencers and, you know, people on social media, like these people who'd be known and who have a big number of followers. Usually if they're wearing something, or if they're using a product, basically they say it, and then they tell you, if you want to buy it, just click on the link below and buy it. This is typically an affiliate model. What does it mean? It means if you click on the link below and you buy the product, basically they get a cut out of the sale that was just made. So from one side, they're making money themselves, and from another side, they're boosting the sales of that other company. So for the other company, it's more like marketing, because they're marketing their product, and they'll be for that person, say, and they'll be getting more sales, and that person is making money because of its, you know, the fact it's famous, and there's a number of people who are going to buy. So if this person gets a cut every time, this makes sense. It's basically the way this person would have decided on its own revenue stream, or one of its revenue streams. Okay, So just to finish with the revenue models, how to choose the right revenue model for one startup. I'll just give you like 3 tips to keep in mind. I'll start with the third one on the right. Basically, you can only know when you experiment. Okay, so you have to try, but before trying, I'll go back to the first point. Think back and like look back at the pain point that you're trying to solve, and ask yourself, how much is my customer able and willing to pay to solve that pain point? Okay, and regarding the second point, which is vitamins versus painkillers, usually we give a lot this metaphor. We encourage startups basically to build what we call painkillers. Why painkillers? Painkillers, when you need them, and you ask basically how much they cost, because they kill pain and they make you feel better. Vitamins are nice to have products or services, but you can skip them. So this is, yes,
question.
sure.
Okay, so this is a dilemma that I'm having. What if your product is not really solving a problem per se? Let's just say it falls under a nice to have product.
Okay, a nice to have product. So it's more a vitamin.
Correct.
Okay, so and then if I ask you what's the problem it's solving, you're solving through this product, what would you tell me?
Creating awareness.
Creating awareness. I mean, here, just like the answer of creating awareness as what's the problem, without me knowing what kind of product or service you have in mind, I think you have to rethink, or maybe maybe not rethink the problem. There's surely a problem you have identified. Maybe instead of creating awareness, maybe you have to look at ways to tackle the problem directly, because like generally people are very reluctant to everything that says we're raising awareness. Like for them, it's something that's done for free, and people are rarely able or rarely willing to pay if something is just raising awareness, you know. For them, it comes like almost for free or naturally, or like, you know, NGOs raise awareness about the environment or breast cancer or whatever. So maybe you have to rethink what you're raising awareness about, and look at the problem and the pain point, and then think of a solution that directly tackles that pain point. In that case, you'd be maybe changing your service offering, and at the same time, you won't be in that dilemma you are in, because you'd be automatically solving a problem and hence not facing the problem of how do I have to sell my offering.
All right, thank you.
You're welcome. I hope this helps. I don't know what's your service or product. I'm just talking in abstract terms, but just from your answer, I was able to you know, reformulate the whole thing that way.
Here you can always find a pain, but you know, pain تفرق عن pain. That's what I mean. Yeah.
Sorry, yeah, sorry. Just if it's not confidential, you're raising awareness about what?
Promoting culture.
Okay, yeah, it's clearly like okay. Again, it might be something. You might have your audience. مثلا nowadays العالم مزروبين ببيوتهم, so culture becomes more a need than a luxury. So if you offer, I'm just like giving an example. If you offer an experience online where people can, you know, become more cultured, this might be seen as a need nowadays, and it's not really a nice to have thing.
Sorry. So, you're hearing me?
I hear you, yes.
Yes. So I can add, if you don't mind.
Yes.
So here we have painkillers, because we can speak about lack of cultures in our and lack of loving our Lebanese culture, if you want to say, or I don't know what he mean about culture, but if I can understand Lebanese culture, we can say that most of the young people are going out of the country. So if we give them, let's say we did a project last time for Syrian refugees,
Yes.
to tell them about their Syrian culture, because most of them are raised in Lebanon 10 years ago that are in the refugees campaigns. So they are raised in Lebanon and they don't like and love their culture there. So we did
Yes.
a whole program to tell them,
Yes.
no, that you need to love your culture there in order to come back.
Okay.
So we pain kill, if you want to say, the ignorance of them about their country. So you can switch it when you know the problem. You can find painkillers to what is the problem.
Definitely, definitely. This is why it's important to scope the problem. And maybe in this case, I don't know, I'm not going to spend a lot of time on this just because I want to make sure, but just one, thanks for your intervention. Just one last point that actually, that just confirms what you were saying. So maybe it could be the case that you need to target the parents, for example, of these kids who would be really, wanting to transmit that culture to the kids, and then it becomes really a problem, and then it becomes a problem more like a need at the parents, at the families level, and then you'd be transforming the whole offering more like a necessity to become more like a necessity, for the culture to be transmitted from one generation to the other. Okay. Anyway, we can take this discussion offline. We're going to have like group coaching sessions, and the group coaching sessions are going to be sessions where you can ask your questions, and we can have these lengthy discussions, with every one of you. Okay. Cool.
Thanks again.
You're welcome. You're welcome. So let me move to, we talked about the revenue model. A startup has revenues and has costs. And basically, because it has revenues and has costs, and typically, ideally, because costs are less than revenues, it makes money. So we have talked about the revenue model. Next time we'll talk about the pricing, but now I want to say a couple of words about costs. So it's important for you, after having, if you remember, I told you here, to identify your customer, what you are offering them, and what revenue model you have in mind. Okay, once these three things have been kind of identified and like put on paper or like recorded somewhere, then you have to think of your costs. Your costs, what am I going to incur? Are you familiar, guys? I think you are, with the business model canvas. I think you've done a session about the lean canvas, which is a sexier version of this business model canvas. But anyway, I just got this one for now. But the point is, in the business model canvas, you have two sections called key activities and key resources, where you list what are the activities that your startup is going to do, and what are the key resources you're going to be needing. So just a couple of words about the business model canvas. The business model canvas is a tool that is supposed to be a one-page business plan for any startup, and it's supposed to save you the hassle of building a 10 to 15 page business plan and then having to redo it all over again. So you work on the business model canvas. Every section is well thought of in terms of content. A Swiss guy who has a PhD came up with this whole thing like 10 years ago, and it has become like a trend in the startup ecosystem around the world. So the other sections are as useful, but for costs, once you think of the activities that the startup is going to be doing, so say, for example, offering trainings, or for example, offering activities, just like the lady just told me a few minutes ago. And then you think of the activities first, and then you think of the resources. The resources are what will I need basically to to actually have these activities. So if my activity is to sell classes, maybe I'll need instructors. If the activity is to sell a certain product, maybe the resources are, you know, people to work in a plant and a few machines. So once you work on these 2 points, basically, namely, I mean, the activities and the resources, you are able to derive your main costs. What am I going to incur as costs as a company? Okay, and to simplify things, you can think of costs in 2 ways. So not in 2 ways. So there are 2 types of costs. Okay, a startup or a company has 2 types of costs. It has the variable costs, which are the costs that are directly related to the amount of work you do or the output that you produce. So let's say I'm producing shoes. Every shoe I produce has a certain cost. So if I produce 10 shoes, and if every shoe cost me $100, my total cost, my total variable cost is $1,000. So it's the cost, it's usually the cost of raw materials or the production costs that are associated with producing 1 piece of output. 1 piece or many pieces, it doesn't matter. The idea with variable cost is that the more I produce, the higher the variable cost would be. So again, to give another example, let's say I produce jars of jam, and every jar costs me $1. If I produce 100 jars, I'd be incurring as a company $100. But if I produce 1,000 jars, I'd be incurring $1,000. So these are the variable costs, and we're going to see shortly where we will see them in the income statement. In front of them, we have the fixed costs. The fixed costs are any cost that you incur independently of the, you know, the output that you produce. So if you have an office and you're renting it, rent is a fixed cost. Any taxes, property taxes or property expenses you pay are fixed costs. The salaries you pay to your employees are fixed costs. The utilities, يعني كهرباء, يعني ماء, anything that is fixed, like if you have a lawyer, you pay him a yearly fee, this is fixed cost. If you have an accountant and you pay him a yearly fee, assuming he's not one of your employees, it's also a fixed cost. Any cost that you pay independently of the sales that you make as a company, okay, this is a fixed cost. Just to go back to variable cost, I gave you the example of things I produce, but they can also be things I don't produce if I'm not a company that produces anything. So if, for example, I import stuff and sell them, okay, the price I pay to import these things, this is my variable cost. Why is it variable? Because if I get 10 items of this thing, I'll be paying 10 times its cost. And if I get 100 items of this thing, I'll be incurring 100 times the amount. Okay, so this is the difference between variable costs and fixed costs. Okay, and these are the 2 things that I would add to the list that I presented here. Basically, in terms of things you have to kind of finalize and be sure of. So who is your target customer? What are you offering them? A product, a service? And then what's the revenue model you have in mind? Are you making them pay for the product, the service? Is it a subscription? Is it a platform? Is it a freemium model? And then in terms of costs, you have to be able to document what are your variable and what are your fixed costs. Okay. And how do you do this? If it seems overwhelming now, think of the components of each. So in terms of variable costs, say I have the cost of, say, the material, and maybe the cost of the people, not the people as salaries, but maybe if you have direct labor. Anyways, I'll not get into the detail of this now, but just think of the direct cost to incur if you have a certain amount. Okay. For example, just to give you an exception, if, for example, you have an app and you're developing an app, in this case, it's one of the few cases I've seen where there are no variable costs. okay? Because not every time you sell an app, you incur a certain cost, except if you're thinking of cloud space or something like this. But generally, there are certain, the point is, there are certain cases, especially with the, you know, the tech startups nowadays and the apps and the platforms, where these variable costs are becoming smaller and smaller. And this is why they're able, the companies are able to grow super fast, because their variable costs are low. And once they're able to cover their fixed costs and able to get a big, a large number of customers, then the profitability and the scaling process becomes important. Okay, I still have half an hour, which is good. I think this will give me enough time to present to you the 3 key financial statements. This is going to be a bit theoretical, and but you will see next time, and once we go into the group coaching sessions, that once you understand these things, you can work with the Excel sheet. So the objective is for each one of you, I'll share with all of you a template, a financial model template, and the objective would be to work on this template to be able to have a simple financial model, simple financial projections for your startup. Why is a financial model important? A financial model is based on a set of assumptions. So you put certain numbers that you think make sense. And the beauty of the financial model is that because you have put these numbers as assumptions, and because of the structure of the model, you can later on, if you think, or if you have the proof, or if you have any kind of indication that these numbers have changed, you can change them a bit straightforwardly, and the whole model would change accordingly. You can see the effect. Okay, so think of it as, if you want, a simple calculator for your business, a simple mirror of your operations. Okay, now to go back to a bit of theory, we have 3 key financial statements. Any company is evaluated financially through these 3 key financial statements. We have what we call the balance sheet, that is called the statement of financial position. It lists what the company has as assets, so what the company owns. Think cash, think equipment. We're going to see all the details. And then the assets are on one side, and then on the other side we have what we call the liabilities, or another section, the equity. I'll get into the details of the balance sheet, but let me start with the income statement, because it's the most straightforward one, and it relates to what I explained today in terms of revenues and costs. For those of you who don't know, costs, expenses are the same. So the income statement is also called what we call the statement of profit and loss. It shows you how much the company has made in terms of revenues, and what costs it has incurred, and what is the profit or the loss that it has made. So in simple terms, revenues minus expenses gives you profit or loss. If the number is positive, it's profit. If it's negative, it's loss. Okay, are you with me till now?
Yes.
Okay.
Yes.
Okay, cool. I'm always wary when I present these things, because okay, sorry, I just saw some people wrote stuff and I was explaining. Okay, guys, can you just like keep these questions in mind, and I'll try to finish 5 minutes before 4:30, or like even if you can stay 5 more minutes, and you'll ask me the questions, because I can't put them in the right context at the moment. Okay, cool. So going back to this. So this is a simple composition format of what we call the income statement. The first line of the income statement is what we call revenues. Okay, revenues are sales. It's a dollar amount. Okay, I'm gonna write here so that you have it later on. So this is a dollar amount. And to simplify it, revenues are price times quantity. So if, for example, you're selling, say you are selling one product and you're selling it at $10 and you've sold 100 items, your revenues is 10 times 100, which is 1,000. This is basically the money that you have cashed from your customers, okay? Then below it, we have what we call cost of goods sold, which is basically what I was explaining earlier as variable costs. So I'm going back there and going to put COGS so that you relate these two later on when you read the presentation again. So cost of goods sold, basically, as the name implies, it's the cost of the goods that you sold. So if these 100 that you sold, okay, each one of them, you acquired it, say you bought it from abroad, okay, at $7, okay, each, then your cost of goods sold is I'm gonna write it here as well. So I'm gonna say unit cost times quantity. And here it's unit price times quantity. Okay, the difference between these two numbers, so the difference between revenues and cost of goods sold is what we call the gross profit. Okay, the gross profit, it's, if you want, the first line of profit on this income statement, but it's gross. It's gross because I have not removed from it the other expenses that I'm incurring. Okay, so this is gross profit. Then I have to remove from it what we call operating expenses, which are no other than actually what we call here the fixed costs. These fixed costs are the operating expenses. So everything that relates to rent, to utilities, to other professional fees that you incur, other fixed expenses that you incur, these are operating expenses, okay? Then I have to subtract, you see the minus here up on the left, okay? So I have to subtract the operating expenses from gross profit in order to get what we call the operating income, okay? It's usually called EBIT, which stands for earnings before income tax. Okay, this is what we call the operating income. Okay, it means, what does this number mean? It means how much income I'm able to generate from the operations of my business. And then if the company has a loan or it has debt and it has to pay the interest on this debt, this interest has to be deducted on the line after it, in addition to any taxes it pays. Okay, so and if I deduct these two things, like the interest on the debt and the income taxes from the operating income, I get what we call the net income, which is basically the profit or loss. Basically, if this net income is positive, it's a profit. If net income is negative, it's a loss. Okay, so this is a simple structure of the income statement. Is it clear?
Crystal.
Sorry?
It's crystal clear.
Okay, crystal clear. Okay, great. Okay, so it's again, the income statement, sometimes it's called income statement, sometimes it's called statement of operations, sometimes it's called statement of profit and loss. It's all the same. Okay, so the role of this income statement is to detail the transactions behind the operations of a business. So as you saw, it keeps track of revenues and expenses and resulting profits or losses. Okay, so this is, if you want, this is a zoom in on the first section of it, which is the revenues. That is sometimes called sales, sometimes it's called also turnover. Okay, so this is what you get from selling your goods or services. The cost of goods sold, I explained what they were, so direct operating expenses. And the difference between the two is what we call the gross profit, as you've seen on the other slide. Okay, If we divide the gross profit by the revenues, we got what we call the gross profit margin, and it's generally a percentage. Okay, so to take a simple example, if my revenues were 100 and my cost of goods sold were 40, my gross profit is 60. If I divide the 60 by 100, it gives me 60%. So my gross profit margin is 60%. Okay? And the higher this gross profit margin is, the better it is. Why? Because it means I can still deduct the expenses, the operating expenses below the gross profit and still be profitable. Okay. Conversely, if, for example, the gross profit margin, it's usually called gross profit margin or gross margin. If the gross margin is, let's say 15%, okay, and then I deduct the other expenses, I might end up at the end with a negative net income, because I don't have enough, cushion to be profitable. Okay, so I think this is a repetition, but just in terms of terminology, because like the same terms are sometimes called different things. So as I told you, sales are sometimes called turnover or revenues. Cost of goods sold are usually cost of goods sold. You can also say they're sometimes called variable costs. Gross profit is gross profit. Operating expenses, sometimes they're called SG&A, which stands for selling, general, and administrative expenses. Okay. Just a small note without getting into the details. These operating expenses often include a term that is called depreciation, okay, or another term that is amortization. I'll explain depreciation briefly, and amortization is the same, but for patents. Depreciation basically means, in simple terms, it means that if, for example, today you buy a big asset, or you have a big capital expenditure for your business. Let's say you buy a machine, and this machine, it costs you $10,000, okay? You're not going to actually incur the cost of the machine during 1 year. And you're going to spread that cost over a number of years, basically the number of years during which the machine is, can be used. And this number of years is what we call the useful life of the asset. So don't look at the slide, just listen to what I'm saying. Let's say you buy a machine that costs you today $10,000, and that's going to last for 5 years, okay? Assuming what we call a straight line depreciation. I don't want you to get too messy about this. Just let's say the machine costs you $10,000 and it's going for 5 years. It means on average per year, this machine is going to cost you $2,000, which is 10,000 divided by the 5 years, which are its useful life. And then what you will be incurring as an expense every year as depreciation is the 2,000 over 5 years. Then over 5 years, you will have basically kind of used the $10,000 machine that you acquired. The principle of depreciation is that we do not actually put the full cost of any machine or equipment or heavy kind of machinery or anything that we call capital expenditure. We do not put it in one single year. We look at what we call the useful life of the asset, and then we spread that cost over a number of years. Okay? Is it clear?
What's salvage value? Sorry, my wife is
Yeah, salvage value is basically the value at which you can expect to sell the asset at the end of its useful life. So for example, I didn't mention because it makes it a bit more complicated, but I'm going to give you an example. This same example I just gave you. Let's say that you bought a machine that costs $10,000, but you know that in 5 years you can sell it, okay, for $5,000. Okay, so the depreciation is actually 10,000 minus 5,000 divided by 5 years, which basically makes a depreciation 1,000 per year and not 2,000. In the case I gave you, what I assumed, and I told you I took 10,000 and I divided it by 5, which is the useful life of the asset, I assumed that the salvage value is 0. So I assume that at the end of the 5th year, I'm not going to be able to sell it. So basically this would need to be, you know, put in the garbage bin. But oftentimes it's not the case. So think of a car. If you have a car, if you get a car today, and then 5 years down the line, you decide to leave the country, God forbid, then you're going to sell the car, right? You sell it at a certain value that's much less than the value at which you acquired the car. This value is what we call the salvage value. And the number of years during which you would have used the asset is what we call the useful life of the asset. And once you do cost of the asset minus salvage value divided by the useful life of the asset, you get the depreciation per year. Is it clear?
Yeah, it's clear. So far it's fine.
Yeah.
Okay. Others, is it clear? Please don't.
Yes. Yes, please.
Okay, cool. So this depreciation, this is usually, this item, if you want, this line is usually one of the lines of the operating expenses. Remember, I told you here in the fixed costs that we have maybe rent and utilities and you know, marketing expenses, and every kind of expense is not directly related to the output, so to the sales of what you're selling. So depreciation would be one of these items. Okay. Okay, for amortization, because sometimes amortization is also included in these, it's actually the same, but when we are actually amortizing or depreciating a patent. So if a company bought a patent or a trademark or something that is non-tangible, okay? Depreciation refers to tangible assets. Tangible means you can touch them. Okay, think of a car, think of a machine, think of a plant, think of anything that you can see and touch. This is depreciated. Okay, and anything that you cannot, like, you know, a patent or a trademark, and it follows the same logic where the cost is spread over a number of years. This is called amortization. So I think now you're good with the basic understanding of the income statement. One last thing, the net income. So on this slide, I'm just going to maximize the slide. On this slide here, we're starting with operating income, okay, which is basically what I get when I subtract the operating expenses from the gross profit. Okay, so go back here. The operating income is here, the last line. Okay, so just follow with me. On this slide, we're starting with the revenues. It always starts with the revenues or the sales. We subtract cost of goods sold. We get to gross profit, and then we deduct from gross profit everything that we call operating expenses, including depreciation, including amortization. We get to what we call operating income. And then if I have a certain interest on a debt, we have to pay it. So we have to also deduct it. We get what we call earnings before tax. Then we remove taxes and we get to net income, which is basically the profit or the loss. Okay, this is an exercise that you can do later on. Okay, I just want to introduce to you the concept of like two new terms that you would see in financial statements and in financial models. One of them is called dividends and one of them is called retained earnings. And basically it's quite straightforward, because once a company has made a profit or a net income, it usually decides if it wants to distribute dividends, which means if the owners of the company want to take that profit, or if it wants to keep that profit in the company and reinvest it. Okay, in case the founders take the money, this is dividend. Okay, and typically they decide to take part of the money. So typically they decide to take, for example, 20% or 30%, and the other 70% remain in the company as retained earnings. So basically, net income is made of these two components, the dividends and the retained earnings. If, for example, just to give an example, a company made a net income of $1,000, and it decided to pay dividends. Okay, usually dividends are expressed in a percentage. We say there is a payout ratio of 30%, let's say. That means that 30% of the net income is going to be paid to the owners of the company. They're going to take it home. Okay, they take the cash and they go home. So this means that the net income that was 1,000, we decided to pay 30% of it as dividends. So $300 were paid as dividends, and the remaining 700, because 1,000 minus 300 equals 700. These are the retained. Sorry, these are the retained. I'm sorry. These are the retained earnings that remain in the company. Okay, so just to read you what's written on the slide and make sure that you understand it. Dividend of a company's earnings يعني net income, يعني net profit, which it returns to investors, usually as a cash payment. Example, a company made a yearly net income of $50,000. Its dividend payout ratio, 20%. So what is the amount of dividends paid to the company's shareholders? Who can tell me?
It's
20K.
50,000.
Correct.
50,000 times 40%.
Times 40%. And the retained earnings is the remaining amount. It's actually the amount of, yes. Hello?
Yeah. It's 20,000 and 30,000.
Yes, correct. Okay, so the retained earnings is the amount of net income left over for the business after it has paid out dividends to its shareholders. Okay, so I think this is clear to you guys. Okay, so just to show you how it works over years, okay? So let's say a company started in 2017. It had zero retained earnings because it just started. And then it made a net income of 50,000. And then the dividends was 20% payout, which means 20% of the 50,000, which equals 10,000. Then it had retained earnings on December 31, so at the end of the year, of 40,000. How did I calculate the 40,000? It's 50,000 minus the 10,000 dividends. Because net income is always the sum of the dividends and the retained earnings. Once I have the payout of the dividends, I applied it to the net income, I calculated the dividends, and the difference between the two is the retained earnings on December 31, okay, of 2017. But you have to pay attention that then I moved to 2018, and what was my retained earnings on December 31 of 2017 became my retained earnings on January 1 of 2018. So I carried these retained earnings with me. So typically, if I made a certain net income and I took only part of it as dividends and left the remaining amount in the company on December 31, I'm supposed to come back on January 1 of the next year, finding this amount in the company. That's why the retained earnings on January 1 are 40,000. And then during 2018, I made a net income of 80,000. Okay, that has nothing to do with the 40,000 that are retained earnings. Then I apply the 20% dividend payout, okay? And then I get as dividends 16,000. Then the retained earnings on December 31, how do I calculate them? It's actually the retained earnings on January 1. I'm looking at the year 2018. January 1, so 40,000 plus the net income that I made during that year minus the dividends that I made, okay, that I gave, that I distributed during that year. This gets me the retained earnings on December 31. Okay, this is just to show you that when we start the business, we have retained earnings of 0, but then when we accumulate net income and distribute dividends, there is always retained earnings at the end of the year that I carry with me to the beginning of the next year. Okay, so just keep this slide in mind, just to understand that amounts like build on each other. So the mistake to make would be, for example, in 2018, if I tell you that I made a net income of 80,000 and I distributed dividends of 16,000, if you tell me the difference between the two, which is 64,000, is the retained earnings on December 31, this is a mistake because the business did not start during that year and I have retained earnings that I carried from the year before. Is it clear?
Clear.
Okay. Everybody clear?
Yes.
Okay. If it's not clear, it's okay. You can always ask me questions later on, maybe during the group coaching, or reach out to me separately. I'll answer all your questions. Okay. So just to make sure you got the key terms. So match up the terms that are interchangeable. So if I tell you revenue, what term on the right is equivalent to revenue? Sales. Very good. Okay. Operating profit.
EBIT.
EBIT, perfect. Direct operating costs.
Cost of goods sold.
Cost of goods sold. Okay, great. And net income?
Net
Hey.
profit.
Okay. Okay. Okay, fine. It's 4:30, so I'll pick up from here next time. I'll go into the balance sheet and the cash flow and the Excel directly to explain to you how basically. So I'll try next time to have the balance sheet and the cash flow covered in 45 minutes, and the remaining 45 minutes will go into the financial model. Do you think we need 2 hours next time instead of 1 hour and a half? Is it okay for you actually? If we do a session of 2 hours, just to make sure I cover everything and we go through the Excel?
I would
It's
ask.
okay.
No, shouldn't be a
okay.
problem.
Okay, no, I don't want us to find ourselves next time with part of the material. So can we split it? I mean, 1 hour and a half every time, Mona?
For me, I don't have a problem.
طيب, okay, I will discuss this with the management and come back to you.
Okay.
Okay. Do you have any questions regarding what we discussed today?
For me, it's
Can you
okay.
just
Thank
please just send us the what's it called, the presentation, so we can just go over it as well, just review our notes.
Yes, I'll do the part I presented today.
Yes, please.
Okay, great, sure. طيب, guys, thank you very much for attending, and stay safe, as you say.
Thank you.
Thank
You're
you.
welcome.
Thank you.
Thank you.
Thank you.